Agency owners have a ton to think about every single day, from serving clients to growing the business, leading the team, etc., etc. Then there's the back office grind. Things like reconciling commissions, payroll, tax prep, HR compliance, blah, blah, blah. It's all necessary, but incredibly time consuming. That's where our friends and partners over at Agency Point come in to help. Agency Point specializes in all the details agencies can't afford to ignore: accounting, tax, HR, and legal. They can even handle commission reconciliation so that nothing slips through the cracks. And if you've heard us talk, you know that this is one of the most important things that agencies must do. By managing the back office essentials, they free up agency leaders and their leadership team to focus on strategy, growth, and clients. An agency that works with them told us, Agency Point gave me back 10 hours a week. And now I spend that time building my business, knowing the foundation is solid. If you're looking for a trusted partner who can help lighten the load without competing for your strategy seat, check out Agency Point.
It's gotten to the point now where these quote unquote tax strategists online have been identified by the IRS. They're now publishing guidance on it on their website. So anybody can go there and kind of check out the Dirty Dozen list. It's the IRS's list of proposed tax strategies that they don't like and that they will aggressively audit.
Welcome to the Insurance Refocused podcast, where we're highlighting real agent stories and how they are innovating to respond to the changes and challenges happening in the independent insurance industry. My name's Lindsay, and I can't wait to introduce you to my amazing co-host, who just so happens to be my mom, Carey Wallace. Mom, how you doing today?
I'm doing well, Lindsay. I was thinking I'm going to do this podcast and then I'm going to head on a plane. And I love the little small talk things that you get on a plane. I'm actually gearing up for it, to be quite honest with you. But I'm good. I'm getting ready to head on a pretty big trip, and life is good. How about you?
I'm good. We were just chatting before we hit record about small talk things and people asking what you do. And I was at kind of an event last night. It was like a live music thing here in Charleston. And there was a volunteer that I was trying to chat with, that he was chatting about what he did with the people in front of us in line. And he must have known them or something, because he was super weird with me. But he asked me what I did. And I said, I work in the insurance industry, but I don't sell insurance, but I'm adjacent. And he just did not have a great response to that. He said absolutely nothing, kind of nodded his head at me, and then moved on with his day. And then later, as we were getting our pizza, he was like, "You heard of AIG?" And I was like, "Yeah, I've heard of AIG, but I can't really do anything for you about that. Like, they're a carrier. I just told you I don't sell insurance. So there's a lot of weird conversations I feel like I have with random people in public about my insurance, but not insurance job."
My favorite is I'm on a plane and they're like, "Are you going there? Are you going home? Or are you going somewhere?" And I tell them I'm going somewhere. "Great. For work or pleasure?" And I say, "Work." "Really? What are you doing there?" I'm like, I'm a speaker." And they're like, "Well, what do you speak about?" And this is where, they're like, "Oh, that's cool. You're a speaker. What do you speak about?" And I'm thinking I should just start making stuff up, because when I say I speak about people buying and selling their independent insurance agency, they like physically turn away from me. Like that doesn't end with a really good segue to a conversation. It's almost like I suck the air out of the airplane right at that point, which is okay, because my beats go in and then I'm listening to my music and we're all good, right? So anyway.
I'm sure our guest today, David, has some similar stories. David, do you tell people in public that you are a tax lawyer, or do you just kind of let that one? How does that one go for you?
Not if I can avoid it, but inevitably, once you say you're an attorney, people are like, you do criminal, you do family, something exciting. I've seen Suits. Like, what do you do? I'm like, well, I do tax law. So then I get the eyes glaze over, and the conversation typically goes in one of two directions. It's like, well, I hope I don't ever need you, or, oh, I really need to talk to you. So, uh, and then we usually have an interesting conversation about the crazy tax situations that people get themselves into. So
Got it. Do
happy
you
to
like
be
start your
here.
timer on your phone? Like, okay, the billing starts now.
Like, wait just 1 second. Click. Okay, go ahead.
What was your routing number again?
So before we move away from funny stories about what people do, I have to tell a quick story because this is hilarious. So my husband and I are on a trip, and our kids make friends with other kids at the resort. It was really fun. And the four parents decide to put their kids in kids club, and we're going to go out to dinner. And, we're focused on our kids and whatever. So we're sitting at dinner, and a normal thing to ask is, so what do you do? Right. And so we asked this other couple what they do, and they're very elusive. And we're like, oh, this is exciting. Maybe they're like spies or whatever. And we really I think they went to the restroom or whatever. And we're like, oh my gosh, they won't tell us. So there has to be a story here. Right. So Kevin and I are thinking it's really exciting stuff. Oh, I know what happened. Something happened at their office and they had to get up and deal with it. And we were like, oh, they won't tell us what they do and whatever. Come to find out, they're both dentists, but they didn't want to tell us that they're dentists because people immediately tell them their most horrible situation with their own dental work or whatever. But it was really fun for about a half hour when we were trying to they're spies or they're undercover or they're this or they're that. And they were dentists. It was not exciting at all. Yeah, whatever. It was pretty funny.
Awesome.
So it could be worse. People could be telling you about their dental problems instead of their tax law issues,
That's true. I'm not a big fan of talking about stuff going on in people's teeth. So
not at all. Not at all. Well, let's do this. I can tell you that we are getting ready to end towards the end of the year. And I know for all of my CFO clients, we have been projecting where everybody's going to end the year. And part of that conversation is, have you done the appropriate tax planning throughout your year? Or are you going to be shocked by an unexpected bill if you haven't gotten the right tax advice through the end of the year? And oftentimes, David, when I have these conversations, either people love the advice that they're getting or they think that their tax advisors might not be aggressive enough in the things that they're advising. There's a really polarizing view out there about what business owners can do to effectively tax plan. So I'd love to just tackle this and give some tips to people, things to maybe to ask their tax advisors, or things to think about as business owners. If you wouldn't mind diving into this topic, I would love to give you the floor and just talk about what should agency owners be thinking about.
Well, yeah, there's so much information and then that kind of recent buzzword we've seen over the years, misinformation about tax planning for business owners in general, including agency owners. I think the IRS just recently reported in the last month or so that over $162 million in penalties against business owners who were following those viral tax hacks that we all see on our phones. We're scrolling through social media and some guy or gal shows up and is like, oh, you've got to do this. You're not doing this. Well, you're losing money. And it's gotten to the point now where these quote unquote tax strategists online have been identified by the IRS. They're now publishing guidance on it on their website. So anybody can go there and kind of check out the Dirty Dozen list. It's the IRS's list of proposed tax strategies that they don't like and that they will aggressively audit. And so again, $162 million in penalties alone. That's not just the tax, that's penalties.
Wow.
Which means there was a substantial more amount of taxable income that business owners had to then take onto their returns and pay taxes, plus the interest. That doesn't even cover the interest that's always accruing on those past due taxes. So I think it's totally relevant for us to have the conversation and talk about what are some tried and true strategies. I'm not afraid of aggressive tax planning if it's legitimate and it makes sense for your business. But just doing something for the sake of trying to save taxes isn't usually a good good strategy or good decision-making paradigm. So there are always like a checklist of, well, let's talk about the biggest kind of sources of savings and then work our way down. The first is always going to be your state taxes. So we want to think through, what kind of state taxes am I paying? For some states, the tax rates are just astronomical, in my opinion. If you're in California and you're in the highest income tax bracket, you're paying 13.3%. There's no such thing as capital gains. So it's just 13.3% across the board. And every year they're trying to raise it for wealthy individuals on sales of businesses, sales of property. So sometimes just making a shift in where you live and where you conduct business is going to actually provide the biggest tax savings for you. Now, that's not always practical. We've got families. We've got our clients in one location. I know a lot of agency owners who have clients across the country, and maybe they have some flexibility to move their headquarters to a new location. But it's not possible for everybody. But I would say definitely sit down and have that conversation with your key business advisors, your family members, and talk about just practically what are the savings that you could have if you move to a different state. And in a lot of cases, the move itself, just those state tax savings, could actually subsidize the cost of the new home and getting set up in that new location. So it's definitely worth looking into.
So before we move off of that one, can I ask you a question about what about as people become remote businesses? Like where's the flexibility in that when you can choose for it to be somewhere else? Maybe everybody goes remote and there is no location. What are the rules around that?
Yeah, so even though you may not have a brick and mortar, there's always a corporate headquarters. And so if you've gone completely remote, the corporate headquarters is going to be wherever the owners are living and really running the business. So if that might be from your house, that is your corporate headquarters. So the goal would be, if you've got that kind of flexibility, how hard would it be to move to another state and shift that corporate headquarters to that new location? Some states have rules where they don't want you to leave. And so you got to jump through some hoops to move your entity out of that state into the new preferred state. But once you get there, then you've got your principal place of business at your new home. And then you just need to start being mindful of the just normal everyday business practicality of, okay, do I have employees in a different state? Do I need to get my company now registered in that state as a foreign entity doing business because I have employees there, boots on the ground, so to speak. So you may still need to register in the state you left, and maybe there is a little bit of tax that you're still paying for the revenue that's being generated within that state where you're registered. But overall, you should still see a savings.
Yeah, that's something to think about, though. There's lots of people that could be an option. That could be something to consider. So awesome. So let's say we can't move. Can't up and move. What are some other things that every business owner should be thinking about, have in the back of their mind so they're tax planning?
Yeah, the next step is, okay, have I structured my entity in the most tax efficient manner on the reporting side? What is that number on that tax return that I'm filing? Is it a 1040 because I'm a sole proprietor? Is it an 1120 because I'm a C Corp? Is it an 1120S because I'm an S Corp? Or is it a 1065 because I'm in a partnership of some kind? And really, when we look at all of those, what we see particularly for insurance agencies is S Corp is where you want to be. So you can be a corporation, you can be an LLC, and you make an S election to file that 1120S. That's going to allow you to be more strategic in other areas outside of income tax, like your payroll tax liability, right? We don't need to take big salaries or guaranteed payments that are all going to be subject to more taxes. We can actually structure it so that we take a reasonable wage, probably $100,000 to $150,000, depending on the size of the agency, of course. And then the rest we have is distributions of income. And by doing that, we've now limited the amount of payroll taxes that we're going to be paying to the state and federal government. So that's probably the next biggest area of savings. And I'd say 90% of the cases, S Corp is where most agencies are going to want to be. There might be individual cases where you've got a corporation that's a C Corp and it's been a C Corp for a long time because it's, multi-generational agency and S Corps just didn't exist back then. And then you have to make the decision, okay, can we save some money by making the S election now? And in doing so, are we willing to give up maybe some benefits from having a C Corp when we go to sell later? And I mean, it's kind of a much longer discussion to get into the benefits of a C Corp sale, but there is some benefit to having a C Corp if you can sell the stock of your C Corp. And that's really the key to that strategy is.
Yeah, that's probably an episode in and of itself, without question.
Exactly.
Because you and I have had multiple conversations where agencies are they're getting ready for an exit, or they think they might be getting ready for an internal transition, external sale, etc. And they have to weigh the options of what's the benefit of being a C Corp, what's the benefit of transitioning to an S Corp, and think about how that impacts everybody involved in that sale all the way around. So I will put a pin in that one. And maybe let's make that a much longer conversation when it comes to it. So we will definitely come back to that one. What about some things that you're moving through the year and there could be decisions that you make that are less permanent than where you do business and what the corporate structure is of your agency, but more year-to-year decisions that you can make for inside your business?
Well, one of the big ones can be looking at what kinds of tax credits or deductions can my business get. Something that most agency owners don't really think about is agency owners can qualify for research and development credits if they start to formalize their processes into their own CRM or their own software that they're having designed and developed for their company. And so definitely you want to explore, do I qualify for any research and development credits? So that's one thing. Another might be, do I want to buy a vehicle? And, there's some rules about that. But with the passing of the One Big Beautiful Bill, as it's called, you're going to be able to get bonus depreciation on purchases of vehicles that have more than 6,000 pound weight. And I think it's the gross vehicle weight. And then you use it for 50% or more for business activities. So it requires you to be like, okay, I'd really like that G-Wagon. And maybe I can get that G-Wagon now as a business deduction if I'm following the rules. So it's sitting down with your tax guy and talking through those issues. Like, okay, we want to buy this vehicle. We're going to have the company buy it. And then you just need to track the actual business use, making sure that you're using it for business as required by the IRS. And sometimes people don't want to take the time to track that. And that's where you get caught up and tripped up in audits. You want to make sure that you're doing that. Another might be like, okay, do we need a brick and mortar? Does it make sense for us to lease an office location, or do we want to look into buying an office location that the business can use? Maybe we set up an LLC, we buy the office location, we then do a cost segregation study so that we can get some bonus depreciation and help reduce the overall cost of the building in the first couple years. There's trade-offs with every tax strategy. If I get a deduction today for an expense on an asset, I might have to pay long-term capital gains later, or not long-term capital gains, but ordinary income later on when I sell it.
Yeah.
But in the meantime, I've acquired a building and I've helped reduce the out-of-pocket cost.
Yeah. Some of the things, I guess one of the things that I see online as one of those tax strategies is putting your kids or your children on your payroll. Is that a strategy that you're seeing agencies actually use? Because there are a lot of family agencies that they might actually have their child working for them, or they might not.
Yeah, so we want to distinguish between adult children and minor children, right? So adult children who aren't showing up on your tax return as a dependent, if they're working for the company, they're actually doing something and you're paying them, that's totally legit and normal. That's not really what these people are trying to promote. What they're typically trying to promote is you've got minor children, and how do I shift some taxable income from me over to my children who don't have to pay taxes typically if they're making less than like 15,000 a year or so. And so I do see people try to implement that strategy. They will put their child on payroll for $1,000 a month. They will even go and try to get retirement accounts set up for those kids, with the idea that they're going to have some sort of good credit score by the time they turn 18. What the IRS is always going to be looking for is, did that child actually perform a service for you? Did you pay fair market value for that service? And there's lots of cases on this, going back a very long time. And so those are the two key criteria. What is my kid doing for me? Some people like to say they're advertising. They might be running your social media account, whatever it is. How much time are they spending doing that activity? And are you paying them a fair market rate? And sometimes it might require you to go out and get some sort of a study or an analysis done to actually substantiate, the value of the services they're offering, or get price quotes from people in that industry. But it's very fact and circumstance. The IRS is going to look to see if you really are treating them like they're performing a service for you.
Yeah. So let's go back to the car for a minute, because I love this. Let's say we're in, it's November 22nd, and someone looks at their P&L and they're like, holy cow, my profit is a bit better. Oh, I'll give you even better. There's a hard market. The revenue's been increasing, and now my profit is increasing, and I'm going to have more profit this year than I did before. My tax advisor gave me my tax estimate, and it's actually higher than what I thought it was going to be. What are some ways that I can reduce that? Okay. So I think I'm going to not only buy myself a car, but maybe maybe my wife does the books for the agency, and I'm going to buy her a car as well. What kinds of things would you say about that? And if they buy it in November, how much tax benefit is there in the same year? And I'm giving you like a word problem, if you will. But these are the kinds of things, these are practical things that come up that I would love, love, love to hear the thought process. You don't have to do the math for me, but what's the thought process of what that really means for that year?
It's starting to sound like a bar exam question. Jeez.
I know. You're welcome.
So, in California, the state bar will actually certify tax attorneys. And there's 200,000 attorneys in California. About 300 of us are actually certified as tax attorneys. And we actually have to sit through an exam as part of that process to get certified. So it's like a second bar just in tax.
No way, really?
So maybe you should be writing the questions for that.
I'm going to. As a matter of fact, I'm going to lobby. Maybe I can put my questions in there.
Yeah. So one of the great things about the vehicle expense deductions is going to be that you get to take it. You get this bonus depreciation, so you get to accelerate the depreciation all into the current year that you actually purchased the vehicle. So it might be November, you're getting a bonus or profit sharing payments. So you've got a bunch of cash coming in and you're like, okay, we've got cash to deploy. Let's do it now. Totally fine. As long as you meet the other requirements regarding use, 50% of use, gross vehicle weight over 6,000 pounds, you're going to be just fine in terms of deducting the purchase. You can do it for you, your wife, any other employee that you want to, because again, these are business-owned vehicles. The company itself owns them. The question is always going to come back to, did you use it for business purposes? So again, facts and circumstances. And how are you going to prove that you used it for business purposes if the IRS wants to audit you?
Yep. So for someone who's just doing accounting work, Is a
Mhm.
business use driving to and from work?
Commutes typically don't count as business
Mm.
use. That's personal because you got to get there. But driving to other locations, having your company logo on the vehicles can help. You're particularly for agencies where you're doing a lot of driving, like in the Midwest, you got to drive long distances to go see clients. You can do that. And maybe you decide at the end of the day, you're not going to purchase the vehicle. You're just going to look for a mileage reimbursement or a mileage deduction. Then you just want to keep a mileage log
Yeah.
and you're going to deduct the amount of mileage. And you can do that. There's apps that
Yep.
can be used to track mileage. Keeping copies of your oil change can be super helpful. I've had audits where I had an oil change at the beginning of the year, an oil change in the middle of the year, and the oil change at the end of the year. Those were the only records to substantiate mileage the entire time. And the IRS and I were able to come to an agreement that they would accept that minimal documentation. And obviously, we can't guarantee that for every client situation. So I always recommend keep a mileage log,
Yeah.
whether it's a book or an app, and then keep your service records. Hold on to those for the life of the vehicle, and then 3 years after the last return that you had the vehicle, just in case you get audited later.
Yeah. Okay, so let me go to my next favorite question that people ask me, and then I'll let you keep going down your list. I promise not to take us too far off the list. But what about a home office? Like lots and lots and lots of people work from home and maybe split their time between home and office, etc. What are the rules there, and do they vary?
Well, yeah, you can use a home office. Like you can use your home, some section of your house for home office. Then the
Yep.
question is going to be, while you're doing that, I'll give you a good example. I had a client who got audited for home office. The initial auditing agent wanted to go to the house to look at the home office and walked in, saw in the home office a yoga mat rolled up in a bag in the corner. And based on that, the agent said, nope, this isn't a home office. You have personal use here, and I'm going to deny the deduction.
Whoa.
Wow.
So, in my opinion, that was extreme because it's not like the mat was on the floor, clearly showing that she was using the space for a yoga studio. It was rolled up inside a bag in the corner, like if she was just going to grab it real quick and walk out the door.
And walk out, right?
So, yeah, the takeaway there is make sure that home office space really is just for the use of your business. Don't use it for other stuff to the extent you can avoid that. At least keep the appearance that it's just for home office space. Some people are able to dedicate a room in their house, and that's always the best. Sometimes you're just working from your bedroom or even a closet, and that's okay. You're going to figure out the square footage of your house, what the fair market lease rate of that might be, or a percentage of the mortgage, and you're going to deduct that amount. Your utilities you can deduct. I will tell you, it is always easier if you have separate utilities for your business than the rest of the house. But I understand that sometimes electricity and internet, water, that kind of stuff, you can't separate in most cases. So you're going to have to figure out what it can, with your tax person, what the right ratio is for those home office expense deductions. Because the IRS is going to say, well, did you have separate, like if you try to deduct your cable bill, did you have separate cable service for your office versus the other rooms in the house? No. Then they're probably not going to allow it because the majority of the use of the TV is going to be for the family. Phone, get a separate phone line if you're going to have a landline at the house, or just use your business phone. Internet's also another one that's hard. I've had mixed results with the IRS agreeing to accept a percentage. I will tell you, clients that have designated spaces that are separate from the rest of the house have a higher success rate of surviving an audit on home office use. So if you've got like a home with one of those next gen suites where it's got its own door, even better. Like that can be the office space. But at the same time, I've had cases where I've got clients who have separate office space with separate lobby for clients, and still have to go through the very difficult process of negotiating with the IRS on what expenses will be accepted and not accepted. So just treat it as a separate space, just like you would your office if you had to leave the house. And that's going to be your biggest defense.
It's funny, as you're saying that, we are actually buying a house, and there's the opportunity to put a room over the garage. It's called a frog, finished room over the garage.
Mm-hmm.
And originally I was like, man, that'd be a perfect place for my office. But it turns out we won't do that for that space, but it has a separate entrance, separate utilities, separate, like the build is separate, all these things. Like that would be amazing. And I think the key is the more clear you can be on the usage, the better off this is. Most people that have never gone through an IRS audit believe that some of these things we're saying are super restrictive. And I started this saying, my CPA or my tax attorney or my whatever is very rule following. But the challenge is you get to see what those IRS audits look like and how the rulings are going. And the average person doesn't experience that. It is funny, though, when I'm at an event and I'm speaking and I say something like how you classify your employees as a 1099 or a producer. And there's a lot of debate in the room. And then someone will raise their hand and be like, hey, I got audited for that. So I'm just going to, and that's a different type of audit, but I got audited for that. I'm just telling you right now, you should probably listen to what they're saying. Same thing goes for this. If you go through an audit and you have to split hairs about what things are happening, it becomes real for those people. So I love that we're talking about, if you want to do this, do it in this way and make sure you have the support in order to make sure that you don't end up paying penalties, et cetera, for deductions that aren't necessarily true deductions, right? So
yeah, and I can give you like just kind of two stories. One, a couple that sold plants online, so they had to keep the plants stored somewhere. They couldn't afford their brick and mortar anymore, so they closed it, and then they moved all of their inventory into their home. And so most of the inventory was in a special space within the garage that they created. So they were running this business out of their home. They got audited. We had to go in with photographs showing how the space was being used specifically just for the business purpose. And so being able to substantiate that's the buzzword the IRS likes to hear, substantiation. They passed audit scrutiny. Whereas I had another client who tried to take advantage of a special tax rule that says if you rent your house out for less than 14 days, you don't have to report the income. So what did they do? They rented their house out for 14 days to their business. They wrote a huge check to themselves from the business to themselves. They took the deduction because the business rented the use of the house for it was like a Christmas party or something for 14 days and paid themselves, I kid you not, several $100,000 for those 14 days based on the advice of somebody else that they could do this and the IRS wouldn't care. Well, the deduction gets reported on the return. So it immediately got flagged as being this unusual expense. What was this for? And why wasn't it any sort of like 1099 issued out to the recipient of the cash? And so they did an audit. They looked at what was going on. They said, would you have paid that much money to rent any other venue space for this party, even if it was for a week? And it just came down to like, no, nobody would ever have paid that much money. And so the IRS denied the deduction. And so that ended up costing them like $50,000 in legal fees to try to just defend themselves, plus penalties and interest for underreporting income. It flowed through onto their personal return. It was not a pleasant experience for them. There are definitely benefits to being able to rent out your house short term to your business. But if that's something you're going to choose to do, it's not something we ever advise our clients to do. But if it's something you choose to do, you need to make sure that it's fair market value. You should probably go out and get a third party to tell you, well, what is the value of renting the space out for this period of time?
Or at least, what would I pay for another place in order to do this? Like, at least get some other comparable things. So if someone asked you a question, you can say with a straight face, 100% I do it. Like, here are 4 other options. I just chose to do it here. So, yeah.
Yep.
I think that's a perfect example of a reel that you might see and say, this is a perfect idea. And then you don't get the context behind it. You do something that you think makes sense, and it could unravel pretty quickly, sadly. Yeah. So are there any other major things as a business, as people are marching towards the end of the year, that we should highlight for them as things they should be thinking about from a tax standpoint?
There might be things on the more personal level. Do they want to make any charitable contributions?
Yeah.
Do they, and do we want to, people, everybody's at different stages in lives. So I'm always hesitant to talk about things that maybe don't apply to everybody. But for people who are more on the high net worth side and they have charities that they like to support, definitely charitable giving at the end of the year is one thing to think about, because we can get deductions for those. We can set those up in various kinds of trusts so that that the client is able to have more control or say over how the money is being used and what charities are being supported. It might be that I don't have a charity today, but I know I want to start making donations to charities. So that would be one reason to use a trust, or we can define a class of charities that might be able to receive revenue. So that's always a good one. End of year business planning around the sale or purchase of assets is always important. We talked about vehicles, but there are other assets that we should be looking to purchase, or other equipment. Particularly while we've got this bonus depreciation and we might have a little bit extra cash at the end of the year. Do we want to go ahead and buy a new set of computers, new desks, things like that for our employees? Get those deductions now, be able to reduce our taxable income. So those are always good things to be thinking about. And then what's your long-term exit strategy? Are you thinking about selling in the next year? Do we need to start making important decisions about, let's put some of your ownership into an irrevocable trust for the benefit of your children? So that way we can start getting long-term capital gains treatment down the road on that transfer. Some people want to hold on to the whole company. Some people might want to bring in other owners. We want to make sure we're giving those people enough time to hold that ownership interest for at least a year so they can get long-term capital gains treatment on a sale. So if you're thinking about an exit event or bringing in new owners in the next year or so, at the end of year now is the time to start planning for how you're going to structure that. So you give everybody enough time for the deal to, what I call, season for that capital gains treatment.
Those are some really great things to think about, but none of which were employ your child, pay yourself, rent your house, all those things. So beware of the reels that you might see as you're scrolling social media. And if you see something and it sounds like something that you want to consider, I would say seek advice before you do it. Don't think those people are one of the, how many did you say, 300 tax attorneys that actually sat through the test that I'm going to, put my questions in on pretty soon here. So I would just seek the advice of the people that actually know. I love that you joined us, David. You're always a wealth of knowledge. I think we're going to do a series on tax because we didn't even talk about personal taxes. We didn't talk about tax treatment in the sale of a business and all the different things you need to think about. So maybe we'll just do a tax series. I think that's necessary, don't you? Yeah.
Yes, I do.
Yeah. But I really appreciate you coming on and sharing your knowledge with us. It's always a pleasure. And the next time you're on a plane, let's think of another thing to say we do. How about that?
I'm going to go with lifeguard. Like a community pool.
Yeah, I love it. What are you going to say, Linz?
I was thinking marine biologist, but I think that might get more questions than I know the
You-
answer to.
You got to go with paleo marine biologist.
Ooh.
What does that
Yeah.
even mean? I don't know what that
You're
means.
studying
I'm going to have to
like
Google that.
dead, you're like fossilized sea creatures from like the dinosaur times.
That'll really shut them up. How about that?
Yeah. I don't know. Maybe I'll be working at McDonald's then.
All right. Well, David, thanks for joining us. I look forward to our next conversation, and we'll see you guys all soon.
Thanks so much for having me, guys. It was great. I appreciate it.
Thanks so much for tuning in to the Insurance Refocused podcast. If you enjoyed the episode, please be sure to hit subscribe and leave us a review so you'll never miss us. Want to learn more about how Agency Focus can help you grow your agency? Head to agency-focus.com or email Carey directly at carey@agency-focus.com. If you need to get in touch with me, feel free to shoot me an email at lindsay@agency-focus.com. Thanks so much for tuning in. We'll see you next week.